listening to the first episode of the RiskStudio podcast. In this section of the podcast, we talk to an expert speaker to get insights into key risk management topics. Today's expert speaker is Gary Bierc, who is CEO of RPM3 Solutions based in US. Gary has served in senior finance and risk management roles. In my interactions with Gary, what has stood out for me is his integrated thinking between risk management, cost management, and performance management. One proof of this integrated thinking is a patent owned by Gary in the US with the title Enterprise-Wide Total Cost of Risk Management using ARQ. This patent is for a methodology Gary has authored, which covers calculating the cost of risk management for an organization and how cost of risk management may influence achievement of business objectives. The methodology closely aligns with the very first principle of ISO 31000, which states that risk management creates and protects value. It further states that risk management contributes to the achievement of objectives and improvement of performance. While the principle is very simple in its context, most organizations still struggle to demonstrate this principle with real financial facts. The methodology we are going to cover today can become a valuable tool for organizations to demonstrate this key ISO 31000 principle. So let's get started. Welcome, Gary, to this episode of RiskStudio.
Thank you, Manoj. I'm very glad to be here.
Okay, so can you start by telling us about what is ARQ and give us a brief introduction to your methodology?
Certainly. ARQ stands for Aggregate Risk Quantification, and it's a business method by which a company can look at their cost structure and be able to ascertain what is the cost of risk enterprise-wide. This has been a bit of a mystery to many risk management practitioners for as long as I've been in the business. And I came up with an approach that definitively makes this happen. Matter of fact, we went as far as to go to the University of Virginia's Darden School of Business to validate this business method to make sure that it was academically true before we went forward to file for a patent. I think the best thing to do, Manoj, is to take a next step further and even ask the next question, which would be, what is cost of risk? Well, I've got a formal definition that we can use, and this is something I came up with, but it's a mouthful, but we can pause for a second and dissect it, and I think it'll make a little bit more sense. When we're talking about cost of risk, what we're talking about is the aggregate total of all costs incurred by an enterprise, whether it be intentionally or unintentionally, as a direct or consequential result of the existence of risk. Now you understand why we use the term aggregate risk quantification as well. But what we're getting at here is that there are certain costs that every business incurs that are there solely because they face risk in their business, which is natural. This is not an unnatural thing. To be successful, obviously, you have to have risk. With no risk, there's no reward. But in that environment, that risk environment, we are incurring costs every day or even allocating resources every day because that risk is there.
Okay, Gary, so there seems to be a lot in this definition, but for our audience who are new to this methodology, is there a more simpler definition you could provide to get us started with the methodology?
Yes, I can. Yes, I can. And actually, this is probably more akin to what we would use with a client as well. Try to keep it very simple. And the simple definition is this. It's just any cost that exists or is incurred because risk exists. So the existence of cost, or we're going to bear the incurred effect of risk on our business. So you keep it that simple. And actually this picture, this silly little picture on the left, is a great example of how cost of risk emerges in a business. And in this particular case, let's assume that this individual works for a tree removal company or a limb removal company, and he's been tasked with taking off this branch on this tree. Now you can see what's about to happen. He's going to fall, and he's going to probably get hurt. So that is the real risk we're concerned with here, is injury. Now, if we know that's going to happen, then businesses, through their assessment process, determine this is a probability, would be taking action or responding to the fact that it's happened a couple times. And they're going to start taking action to adjust towards this risk. So I'll turn this to you, Manoj. What are some of the things you think the company would do then, knowing that this risk was going to happen, that would be an investment or an allocation of resources towards managing this risk?
Well, I think training would be a good start because he's
Yes.
definitely not standing on the right side of the limb. So I would say the investment in training so the accidents can be prevented. Probably some sort of safety clothing, some sort of harnessing to protect him from falling. Would be some examples, and I think the list can go on. But I guess those are two or three lines of investment an organization may need to.
Exactly. And what you're getting at is that there is a trade-off here, right? Either I can just roll the dice and just have people falling off limbs, or I can be making a proactive investment to manage this risk. And we would hope that through that rational business thinking process, that the investment to prevent it is much cheaper than the cost of injury, or even worse, possible death to employees. So you see that this is really how cost emerges in any company. When faced with a risk, a group of trade-off decisions occur to determine how costs are going to be allocated to try to optimize that cost in the profit and loss statement. And that's what we're doing with cost of risk. We're trying to find where that happens in the business.
Okay. And in this case, Gary, when you talk about risk, are you covering any specific type of risk in your methodology, or this can be any type of risk
It could be
within an organization?
any risk in an organization's environment. So that's a great question, because another way of thinking about it is thinking about how risk can affect different aspects of the business. So if you look at it from that perspective, it's like fingerprints. Risk, because it exists, affects different aspects of our business. So, for instance, revenue. Risk can be the reason why our revenue is shifting from quarter to quarter, year to year. It could be our cost structure, same thing. Change in that cost structure could be the result of risk, or even cash flow. So when we're thinking about cost of risk, we're thinking about all those fingerprints and how they affect the business, and gathering those things up and trying to organize them and align them with the specific types of risk that face our business. This gives us some real data that we can now analyze and get some business intelligence from.
So Gary, here to help our audience understand what you mean by fingerprints of risk. So for revenue, would a good example be that a competitor starts a price war against your organization, due to which now you don't get as many new customers because now the customers prefer to go to the competitor instead of buying the products from your company? Would that be an example of a fingerprint of risk on revenue?
Absolutely, absolutely. And the key is first to measure that risk has that effect. Second is then to relate that specific effect back to the event that caused it. But that is a great example.
Okay. And in terms of cost, the example of fingerprint of risk maybe there is a big fire at a major factory, due to which now we have to go and buy new machines for our factory, and then we also have to buy a new set of raw materials for our factory.
Yes, and in that example, that's interesting, because now you have to think about whether that event was insured or not. So if the event was insured, it's any of that out-of-pocket cost that's either under or over the limits of the insurance policy, and then you would obviously be including the cost of the insurance itself. In an uninsured event, then it would be 100% of the cost that affected the business.
Okay. And in terms of cash flow, an example to help maybe that because of the tougher economic conditions, your customers start paying their debt slowly, so there is a slower recovery, or it takes your organization longer to recover revenue, or due revenue from the customers. Would that be an example of how risk may impact the cash flow?
Absolutely. And then, of course, translating it back to cost of risk directly, we would start picking up evidence in that in terms of the amount of interest we're paying on our lines of credit because we're not able to repay them back quickly enough. So that's a great example.
Excellent. Okay, so by touching these three aspects, then really I think is where the methodology is showing that linkage between risk management, cost management, and actually the performance management aspects. Okay, so I'm interested in learning more about the
Well,
methodology.
one thing you need to be thinking about is that it's going to be our job now, if we're going to be applying aggregate risk management, is to pull in aggregate all of these fingerprints, translate them into cost, and gather them together so that we can align them with the specific risks in which they were incurred. So this is where we're going to get the business intelligence to help us with the performance of our company.
Okay.
So why don't I move on, Manoj, and I can give you examples now of how risk actually does create cost. And there are only three ways. And this is really where it starts to get very direct and how you can translate risk back to the effect on cost and performance of your business, and then ultimately seeing how management of risk can have a real impact on the end results of a company as well. Number one, you have to think about that when risk exists and we're faced with it, whether we're consciously doing it or it's done through a series of business decisions made, companies are beginning to allocate resources to try to deal with it, to manage it, to minimize its effect on the organization, or to try to have better capitalization on opportunities. It doesn't matter. They're incurring costs to do that. And I know whether you're looking at ISO 31000 or whether you're looking at COSO ERM, you can be looking at this as a risk treatment or a risk response cost in the business. So great examples are going to be mitigation, elimination, prevention, and controls are what we're trying to enumerate here as we're looking at this one of the three elements that risk creates cost.
Okay, so Gary, just to again help our audience understand this in terms of examples. So if I was a bank and I have a fraud management department to try and minimize the credit card fraud, then the cost of that department, would that something be classified into this category you have just explained to us?
Absolutely. Let's go back to our simple example. The question is, would that department exist if the risk of fraud did not exist?
No.
And the answer would be no. So if that is the case, then yes, we would say that fraud prevention department is actually a cost of risk.
Okay, so basically any cost which are incurred due to putting some sort of risk treatment. So if I'm having some controls, if I have to buy, let's say, a fraud management IT system to try and reduce the level of fraud, then that would also get classified under this part in the methodology.
That's correct. That's very correct.
Okay.
So, I mean, once we know now, which, by the way, these are numbered in order of difficulty in identifying. These kind of costs that we're talking about, we can identify logically in the business. The trick is to look into your chart of accounts and cost structure and begin to partition how these various ways actually are incurred and tracked through the system. So once we get a good understanding of how we're spending money to manage risk, the next thing is then think about how risk then, therefore, can affect us directly or consequentially. So the second component are actually those losses or incidents that occur that, by virtue of their occurrence, have forced us to incur cost. So a simple example of this would be I may be managing the risk of a breakdown of my automobile in the first example, in number one, by getting routine maintenance on my car. But if I have a breakdown in my car and now I have to have a major repair done, that's an incident. And that's where now I'm incurring the cost of the consequences of a breakdown. And I'm also tracking these things through my general ledger, most likely. Another way that these kind of costs are incurred are often companies reserve for them. So they're actually accruing in their income statement for specific types of losses and carrying balances on their balance sheet for some future event that may occur. And those particular accruals we also can find in the general ledger fairly easy if you know where to look.
Right. Okay. So it's not only the outcome of incidents. So, for example, in the case of credit card fraud, if I end up paying 50 million US dollars as compensation to different customers for credit card fraud, then that would get classified under this heading. But also, if I set aside some provision for, let's say, a regulatory fine, which may be coming in 6 months' time, then that provision would also get recorded under this heading.
Exactly, exactly. So under our patent, what we're doing here, as you can see, is we're walking through sort of a hierarchical logic that has you look at the company as having two broad categories of cost, stuff that's cost of risk and stuff that's not. But then we're also then breaking it down in how those costs are incurred. Did I proactively spend the money to try to manage risk, or am I waiting for something to occur and then I'm bearing that cost? So that's really where we are in number one and number two. So it's either I'm managing it or I'm bearing the consequences of it. It's almost like a trade-off decision.
Okay.
The third component is probably the most important one, because once I understand what number one and number two is, then by virtue of that knowledge, I can pull it aside and take a look at my business afresh with those costs removed, and I'm actually looking at my core business. And once I understand what my core business is, I can look at its performance. And ultimately, if you go back to the definition of risk itself in just about any standard I have seen, the definition of risk is always ultimately about the achievement of objectives. And the objective we're trying to achieve is our core business. So if our core business does not achieve, we have been affected consequentially by a portfolio of risk events that have kept us off that target. And by calculating what that is, we've now got the third component and have the true enterprise-wide total cost of risk for our enterprise.
So Gary, in this case, if as an organization we wanted to achieve, let's say, $500 million worth of profits in the current year, and we only achieved $450 million worth of profit, then would you put the difference, $50 million, under this heading here?
I would consider that a cost of risk and would have to be included in how we analyze risk on our business. Absolutely.
Okay, so underachieving of the business objective, and then the margin between what your target and what your actual performance was, is also getting classified as a cost of risk in the methodology.
And consequently, you would also want to look at the overachievement. And if you overachieve, we would look at that as a contra expense or a reduction in our overall cost of risk. So what we're seeing here then is that risk can work for us or against us depending on how well we identify it and manage it. And this is where it really ties back to the value of ERM itself that you brought up in our opener. If we can understand these things and how well we're managing risk, at the end of the day, that core business performance should be dead on, almost to zero. But if we're going to miss, we prefer to overachieve, not underachieve. All right, well, let's look at it this way. This is a way that I think will make things a little more clear. If we think about the fact that in risk management decisions, we're always deciding, if I've got a sidewalk full of glass, I could choose to walk out there barefooted and take the risk of the consequences of that, or I can choose to put on some kind of protection on my foot. I can begin with just socks, or I can go as far as putting on a pair of shoes. But that investment is what I'm doing to treat the risk, and I'm doing in the blue section here. And those costs, the cost of that is what I'm doing to try to minimize the effect or the probability of that risk. What still remains is the possibility that the risk could occur and I'm going to bear cost. So, some cases, it's stuff that I'm going to be able to track very clearly and easily just through my cost structure. We're going to call those the cost of incidents. The other component is how well I perform against my core objectives. Once I have all that enumerated, I can clearly see the trade offs that go on in the risk management decision making process. This also, by the way, Manoj, is why it's so important that ERM is involved in a strategic planning, budgeting, and business review processes in any company. All right, so now that we have a good idea of what we're trying to calculate, what exactly does cost of risk measure? So we're hitting on this theme of trade-offs, and I think that is probably the number one thing, is that we're really trying to get to that net burden that exists in the business that is a result of these risk management trade-off decisions that exist. And what it's doing is it's showing that there's a trade-off between cost and performance. And this is why ERM, I believe, is going to be getting more and more traction over time. It's not only intuitive, but it also has some real monetary reasons to press forward. And the value of ERM can be measured when you understand the cost of risk. Let's take a look at, and I like this slide a lot, Manoj, because I think what it does is it helps the viewer to understand what we're doing with cost of risk. And another key point about cost of risk, and that is that it exists in the business, but it's being obscured from view because the traditional view, the traditional GAAP or financial accounting approach to the financial statements, the four main financial statements, but in particular the income statement. When we look at that, there are a lot of costs that get blurred by being commingled with stuff that is not risk related. So what we're doing when we calculate cost of risk is looking at every single element in that profit and loss statement, and we're identifying cost of risk and that which remains, which we'll call core business, and separating and partitioning the two so that they can be better analyzed and we can begin to tease out how risk is affecting our cost.
Okay, so in this slide, I understand the cost of risk from cost of goods sold perspective. So in this case, if I want to keep, let's say, some buffer of my inventory because there may be some disruption into my supply, then the cost of that inventory may be considered as cost of risk in context of cost of goods sold. What would be an example on the revenue side of cost of risk?
There's several. If I'm in a commercial brands company, I'm going to have things such as returns and allowances that I'm netting against my gross revenue. There could be trade promotions that I'm doing and netting against my revenue. Special discounts that I'm offering, I net against revenue. All of those items really are intended to be levers to use to manage the risk to product demand. So when we're looking at that, we would call those cost of risk, which really gets you back to your gross revenue. But now we can also align them with those specific risk categories and better understand how we're using those risk management levers to manage performance.
Right. And where is the data for all this coming from, Gary? That are you going to the general ledger and the financial books of an organization to get this data?
Absolutely. So what we're looking for is the results or the effect of risk in any given period. So we're not necessarily looking over the horizon here. We're looking at what did happen, the facts that occurred in any period. So yes, we have to go to the general ledger. That's where companies are definitively putting down all of the financial impacts that have occurred for whatever means in that accounting period. Well, what we're doing is a simple cost accounting methodology, but now we're using risk as the activity base, and we're searching through the general ledger to identify those specific types of cost. Once we have that information, we have business intelligence or a view, a lens into how risk affects our performance. Well, let me give you another example, Manoj, on the next slide. Um, a great way of thinking about this is that when you're looking at that general ledger, you've got revenue and you have all of your costs of doing business. And that's typically what businesses look at. And from there, they get to earnings. What we're doing here through this approach, this patent approach we're calling ARQ, is we're separating that cost of doing business into its sub elements. And we're saying one element of it is cost of risk. It exists because risk exists. And then we have our core business. This exists because our mission exists. So if you think of it that way, we have a core mission that our business is trying to achieve, or missions, depending on what type of business. They may have multiple business lines. That is what our core business costs are. And they usually are very much in alignment with the scale of the business and its revenues. On the other hand, the cost of risk is there to manage the risk to the core business. So these costs are being incurred to try to assure revenue growth, to try to assure revenue stability. They're trying to assure that we won't have unexpected losses in our manufacturing line, or unexpected losses due to fraud in a bank, or that we will have reconciliation issues between ATMs and what we're showing in our general ledger. So we're incurring these costs because risk exists, but we also can align them with the specific risk categories as well. And that's going to give us some very interesting perspectives on what are the largest risks in our company. Because, Manoj, my personal contention is, you know what your largest risks are when companies are allocating most of their resources towards them. That's how you can truly know.
Right. So Gary, is one way of understanding this difference is that if I was a retail bank, then I need to have a branch so my customers can come in and they can buy credit cards, they could buy mortgages, and so on. So the cost of the branch, so if I'm paying a rent for that branch, then that would be the cost of business. But
Mm-hmm.
then if I install CCTV cameras into that branch, to prevent theft of cash by employees, or to prevent bank robberies, so I have evidence when those bank robberies happen, and I can hand over the evidence to the investigation agencies, then the cost of CCTV cameras would be classified as the cost of risk.
That's correct. That's correct.
Okay.
So, I mean, here's where the trick comes into it, and I think this is very important. You almost have to think about this is like a code, okay? And using ARQ, we need to decipher from the general ledger code what is the cost of risk. And in doing that, again, let's break it through a very simple analogy. Let's begin. We have the general ledger information, we have revenue, we have all of our costs of doing business. Through a series or a process, this patented process we call ARQ, we're going to separate out what is dedicated cost of risk, meaning the things that are there for the purpose organizationally to manage risk, and then everything else. And we're going to separate it into those two buckets. The next thing we're going to do is take kind of a side view, a horizontal view of those two buckets, and let's get it down to the account code itself, literally what we're spending money on. Once we get it down to that level, what we can do is then separate out from the original two buckets how those buckets actually being spent and why. So a simple one would be revenue, right? Things that are clearly gross revenue items, we're going to put it in its own bucket. But then we can start thinking about things like line item spending. You mentioned earlier, if I'm spending money on a camera to manage fraud, that would be what we would call a discrete cost of risk. But what about if we were trying to finance risk, insurance premiums, any kind of spreads on hedging, those kind of risk financing costs we would categorize separately. And then lastly, remember earlier we were talking about the second component of the three ways that risk creates cost, incidents. Well, if we can identify accounts that are tracking incidents, we'll put it into a fourth bucket. We call that monitored risks. Once we have all of this information now sorted out, what we've got is the cost of risk and what remains. We call that earnings before cost of risk, or core business performance is another way of looking at it. So Manoj, I know you're probably asking, this is very interesting, Gary, but why is cost of risk so important, and why do we need it in an enterprise risk management context? And let me answer the question through one real simple answer, and that it's all about the Q, quantification. And it gets down to, and I've been in enterprise risk management now for about 17, going to be 18 years. If I cannot manage the enterprise I can't measure the risk management process, then I really can't manage it. And eventually somebody's going to ask me the question, this is very interesting stuff, but where's the value? So we want to quantify the effect of not only risk, but risk management on the business. And the effect of risk management is what we're doing here with cost of risk in the ARQ business methodology. We're trying to get at the value of risk management itself. Another very, very important thing to think about is that quantification is critical. And there are things happening in our business every day that are obscured from view because we're not looking at the cost of risk. And these hidden areas can result in not just savings, but possible growth opportunities in the organization. And this is where ERM plays an essential role, by the way, is getting at that stuff. We mentioned earlier that it's about these trade-offs. And if we understand that cost of risk is tied to trade-offs, when cuts are being made in the business, when cost reduction is being made, we can't be treating risk management costs or cost of risk in the same way we're treating cost of core business, because it may not be one-to-one scalable with revenue. We mentioned that it measures enterprise risk management. And of course, this also reveals how risk assessment and the risk management process is such a critical component to strategic planning and how the business actually executes period to period. So once you start bringing quantification into the equation, you start connecting dots on how risk and risk management are actually very essential to the final performance of the company.
So Gary, if I was to identify a couple of situations where this methodology would be useful, so one situation would be that we want to increase our risk management spend, and then the methodology could help me actually identify the various areas within the organization which require additional risk management spend. So I could use the methodology, if I was into that situation. Or the other situation would be where I have to reduce my cost, and now I want to identify which would be the right areas where I can reduce my cost without necessarily having a significant negative impact on my business performance. Then would that be those two scenarios or situations where?
Yes, and I would add two more. I thought that's very good, and I would add two more. And one is that if I've done a risk assessment through my enterprise risk management process, and now I am putting together a strategy to try to treat my risks, and let's call it a risk response strategy to try to have maximum impact on the performance of my business, I can test that through a cost or risk format, but then be able to measure the actual results as the year progresses to see how well we're doing and see that there has been change. So that is one way we can look at this. Another thing, we went back and we talked about the three elements of cost of risk, and the second one being tracking incidents. If you think about it, Manoj, these incidents that we're now tracking and categorizing really are testing the effectiveness of our controls. So we've identified these risks already. We know what they are to the point where we've created an account in our general ledger system, and we're tracking them and including them in our cost structure. We expect them to be very close to what we believe they should be. When they begin to drift away from our target, within some tolerance range, it's telling us how effective our controls are, and we want to know that. But if we're not measuring cost of risk, we can't know that information. So these are all very good examples. Now, the question is why now? And this is a very important question. I firmly believe the world is more risky today than it was when I began in business. Not only because of economic issues like the pictures are showing, Greece burning down over their debt crisis, but it also has to do with technology changing so rapidly, political change happening rapidly. Um, all of these things are changing the way that our cost structures and our business environments are um, adapting over time. And how do we know this? Well, our experience from doing this now since 2004 is that companies are incurring somewhere between 20 and 50% of revenue on the cost of risk. These are staggering numbers. If CEOs and CFOs really understood what cost of risk is and that they're this large, I know they're going to want to have a whole lot more attention placed on them. And if you're an ERM practitioner, your place in the organization is going to grow very, very rapidly as a result of that. So at the end of the day, if I know that it's 20 to 50%, I have clear understanding of business intelligence around this, and I'm the organization that has this information for myself, I've given myself a competitive edge. And now I have an advantage over my competition.
Wow, Gary, that 20 to 50% is really a big number. Is that based on your experience of implementing this methodology?
Yes, it is. I have yet to see anyone below 20%, and we're talking about this on the long haul. You could, from quarter to quarter, be a little bit lower than that, but in the long run, when you're tracking annual costs, I have yet to have a client with a percentage less than 20. So, I mean, to conclude, what I have to say, Manoj, today, I think we need to eventually just step away from the equation and realize that there are real strategic benefits to understanding the cost of risk as an enterprise risk management practitioner. I mean, number one on the top of the list here is that if I understand these costs definitively, now I can begin to articulate to the board and to management previously unseen correlations and relationships that exist between my cost structure and how the company performs. And by drawing those connections, it's making ERM more real and more relevant than just a compliance or governance exercise. I can use internal data to show its benefit, not global data to show its benefit. I think this is important for any ERM practitioner who's looking to take their programs to the next level. I think it also provides some insights into performance that, in a way, are even in advance of any kind of conventional financial reporting KPIs. So, I mean, I'm getting an insight that just doesn't exist. And that insight can change decisions. And therefore, again, ERM finds itself providing a perspective at the decision table where they weren't before by having real data. And again, it all gets down to the language of the C-suite is dollars and cents, and we need to make sure that's in front of them. A third very important thing, and I'm sure you probably have been surmising it over time, when you start to get a handle on cost of risk and understand its parameters and tolerances, you're measuring the effect of risk appetite and risk tolerance in simple dollars terms by measuring cost of risk. So therefore, if there is a change in risk appetite, you can actually see its result by seeing how cost of risk will change as a result of that. And then lastly, we're now getting some metrics in place. If I just take the cost of risk as a percentage of revenue, I'm creating metrics now upon which we can now bring back to the board and management just how well we're doing as a company in managing risk. And this isn't pointing the finger at an ERM department, because we all know that risk management is really handled at the operating level, but it certainly will tell us how well across the board are we doing in managing risk. And if we're having a problem area, we now can start seeing where that problem area is with definitive knowledge to correct it and make it brought back in alignment with our risk tolerance and appetite. Well, Manoj, that's all I have for today with the time allotted. Do you have any other questions for me? If not, I want to thank you for giving me the opportunity to share cost of risk with you and your listeners.
Hey, Gary, thank you very much for that introduction to the methodology. I know now we have the contact details for people who may be interested in learning more about this methodology, because there's definitely a lot more detail to the methodology than what we have covered today. But just in a nutshell, to summarize, what we've learned from this methodology is that if I want to understand the cost of risk management within my organization, then the methodology can help me understand that in terms of actual real dollar figures, because the methodology is proposing that those cost of risk figures, they actually come from the general ledger. So it's not just somebody's estimates or guesstimates. These are real dollar figures. So so the methodology facilitates, for the first time, that we can actually see how much money are we spending on risk management within our organization, and what is the breakdown of that risk management spend in terms of the various headings we had talked about. And I think having insights into that cost of risk breakdown, can help drive a lot of decisions, not only in terms of optimizing and making risk management more effective, but also how increase or decrease in the cost of risk spent can impact the business performance of the organization. And which is why I wanted you to come into this episode, and talk to our audience about the methodology, because I haven't seen any a methodology out there which tries to address that aspect of risk management. So thank you very much for that introduction. And I look forward to welcoming you again in the near future, where maybe we can also cover a case study in a little bit more detail on how this can be applied into an actual organization.
Thank you, Manoj. I would love to come back, and I would love to share a little bit more about how this can help people better manage risk and improve performance.
Excellent. Thank you, Gary.